So, today we're going to be talking about two things. So, the first is to understand the moving parts behind understanding future inflation. And the second is to talk about the decisions that the Fed heads would be likely to make if they're facing certain conditions. So, there are many YouTube videos out there that state that we're going to end up like Venezuela, or we're going to have starving millionaires. And you may be aware that the US added 26% to its money supply in 2020. They're all legitimate fears, but when you go past the headlines, you'll find that the risk is much lower than what a single variable can show. Most of us think of inflation as how quickly the money printers are running. If you're printing lots of money, the interest rates are low, inflation is likely. And if they're not printing money, and the interest rates are high, inflation is low. Although this is a component of inflation, there are actually more factors at play that affect the inflation rate outside of interest rates and money printing. And if you clicked on this video, you're likely interested to know what these variables are, so now I'll go into it. Now, I'm assuming that you're watching this video as you want to know whether inflation is going to happen before it is officially reported. Otherwise, we can just Google what the current inflation rate is and have the answer in less than 1 second. But knowing the formulas will help you understand where inflation is heading before it is crunched by the people that are much smarter than us in deciding what the official inflation number should be. So, to get a competent and non-proficient understanding of inflation, I'll need to explain what money velocity is, what real gross domestic product is, and what M supply is. Understanding inflation and all its variables is a rabbit hole that just goes on and on and on and on, but I'm confident that this video found a good point to stop the digging. Here is the formula to work out inflation. So it is prices, which is the quantity of money multiplied by the money velocity divided by real GDP. So now let's go into explaining that. First, we can talk about money velocity. So money velocity is basically how freely people spend their money. I'll provide an example with a case of low money velocity. Imagine a pre-digital world where you have a $20 note, and in a 1 week time frame, you have to see how much times that $20 note is spent. So if money velocity is high, a person may give it to a cafe for a drink and a snack, and then the cafe uses that $20 note to pay a staff member their wage. And then the staff member uses it to buy a beer at the pub after their shift. And then the bar uses that $20 note to pay an electrician to replace a faulty fuse. And then the electrician uses that $20 note to buy a pizza and watch the footy. Also, how a virus is not a big thing pre-digital money. So there's an example of how money is spent if money velocity is high. Now, if money velocity is low, the original holder will just walk past that cafe and not spend that $20 as they're worried about losing their job next week and they have to save every dollar that they can. So if the $20 stays in the original holder's wallet for a week instead of in the previous example, whereas it changed 5 times, you could say that money velocity is low. So that's money velocity. And now let's talk about the M supply. So here's an oversimplified but not technically correct definition of all the M's, or the money supply. M0 or MB. So this is all the physical money in wallets and the physical money stored in vaults and banks. This is slightly different from one another, but the difference is so inconsequential that I won't bother going into it. And then there's M1. This is physical currency in circulation and bank transfers which are sitting in overnight transfer. So say if you had to wire your friend some money for them buying a pizza, that would be counted in the M1 supply. So M2. This is basically M1 plus money sitting in your bank account and places where money is parked where it can be redeemed in under 3 months' notice. And it must mature in less than 2 years. So basically, this is bank accounts in layman's terms. And then there's M3, and this is basically big bank stuff. Deposits of over $100,000, which draw penalties if you try to withdraw it early, money that's deposited by other countries, and just really big fish stuff. However, if you're reading about the European Central Bank's M3, you have to note that it's the same as everyone else's M2. It's annoying that it's like this, but it's like that the way it is. So out of all the above, M2 is the one that we actually care about. M2 is the number that we like to zoom in on. Again, this is a combination of physical currency in circulation and overnight bank transfers and bank deposits and term deposits. So now we've figured out how to work out the velocity and the money supply. But that is useless unless we can match it against a common yardstick like a country's entire economic performance. So for example, if you looked at China's velocity and supply from the 1980s versus 2010, you would think that they had a massive hyperinflation. Whereas in reality, they've actually had massive rapid growth, and this is pretty obvious when you actually weigh it up against the country's economy. So this is an example of why you need to measure the velocity and the supply against the country's economic size. This is reflected as a statistic referred to as real GDP, or real gross domestic product. which is a collection of all of the money and goods and services provided by that entire country. You may have heard of the phrase nominal GDP that gets used from time to time, but nominal GDP counts the combined cost of goods and services with the current prices, whereas real GDP calculates all costs of goods and services at a constant fixed price, which is why it is better as a yardstick to try to figure out inflation. There's two ways to sort of predict inflation before it is official. So the first one is if the velocity of money and the money supply are growing, whilst the actual economy is not growing. So yes, during the COVID-19, the money printing and the money supply went massively up. But this was done intentionally in a calculated attempt to counter the plunging money velocity due to no one spending the money due to lockdowns. So this is actually done in a calculated move to try and stabilize that multiple with one another. They had to do is to keep the numerator consistent in the prices before the formula is divided with a denominator, which is real GDP, which also would have dropped slightly. So yeah, there is a bit of mathematical guesstimation going on here. And this is still relevant today. Up until now, inflation has not gone too crazy, but bear in mind that velocity is still low because international travel is still closed, and many people do have the harsh memories of losing their jobs even though that they are currently employed again. There is a potential for money velocity to increase, and when that does happen, there's going to be a lot of M2 new money supply for that to be multiplied with. But as for when that happens and how quickly that happens, this is a major headache for the brains trust at the Reserve and Federal Reserve banks to figure out. Furthermore, Federal Reserves and Reserve banks are watching the money velocity very closely, and they can very easily tighten the M2 supply if it is growing faster than what they expected. And the second indicator that we can use now for determining if inflation is going to be growing faster than what is expected is if you notice demand for everything is suddenly outstripping supply. And we actually are seeing this in Australia a little bit right now. We have to think about what's going in the heads of all these big decision makers. They need to make precise decisions based on wildly fluctuating variables which are not completely known. They are a bunch of very smart people, but they are facing an incredibly hard and unprecedented challenge. We have spoken a lot about inflation, but now I want to talk about deflation. Deflation is obviously the opposite of inflation, where everything gets cheaper because no one is wanting to spend the money and they're stuffing their cash inside the mattresses. Now this changes a population's behavior in a way that is very hard to reverse. Now the Great Depression is the most famous example of this. Furthermore, there are very strong, incredibly strong deflationary forces in the Western world right now. Aging demographics for more people retiring from the workforce than people who are entering the workforce. Now, you may have seen the famous talking heads scream about the deflation cliff that we're facing. I want to actually name them. And technically speaking, these people are right, but they failed to consider one variable. And that one variable is that the Reserve banks and the Federal Reserve heads are aware of this as well, and they have corrected course to adjust for this new deflationary force. And it is because of these deflationary risks that we're now at record low interest rates and stuck at these low rates for a while. I should get back to the point that I'm trying to make. If the head of a reserve bank had to pick between deflation and inflation, they would pick inflation every time because they can rein in control of inflation, whereas deflation can just spiral out of control for them. So hopefully this video explains to you some new insight and some more understanding of what Federal Reserve and Reserve Bank decision makers have to deal with. Unlike our government, they are not winners of popularity contests, which I think is a good thing. They're academics who are very aware of the rash and outcalculated actions can cause. And what about the 2008 crash? A large part of that crash was not so much due to the Federal Reserve errors, and it's more to do with loosening of laws and the blind eyes to laws being broken. Now, the Federal Reserve only works with the money supply and they have no control over the laws. And they did do a great job in controlling the money supply post-2008 crash. So, what is my outlook on the future? My outlook is that we may have the occasional quarter where inflation may be higher than expected, but then it'll be reined in for the quarter after it. There is a little bit of guesswork in altering the M0 supply and then to adjust the M2 supply from that in order to keep the prices equation steady. But if they do manage to get it wrong, you can be pretty confident that they'll get it right for the quarter afterwards and so on and so forth. And again, they'll be leaning more on the side of inflation rather than deflation. My educated guess for the future is that we will see soft inflation and occasional quarters of a larger than expected inflation, but it's not going to reign out of control and turn us into Venezuela. Thanks for watching, and don't forget to like and subscribe and all that other stuff that people say at the end of YouTube videos, and now you're free to play outside but you're not legally obligated to. Thanks, bye.